Good afternoon. My name is Joe Pizzullo. I'm from Philadelphia, from the law firm of Pizzullo Rodin. And we're here for the next 2 hours to give a review of the negotiations and documentation of commercial financing documents. So there's no misunderstanding. I'm going to review business documents and real estate documents. The theory today, the theme today, what everyone's told is banks do not make loans today. I would like to take you through, give you the practical ramifications, go through what the negotiation process is all about, and how to get a loan, and how to keep a loan, and how to switch banks. But before I review and proceed, we have an extremely large web audience today on the web, and we have quite a few people here today. So how I teach, I want to talk to you, I want to give and take, I want feedback, and having tried cases over the years, you always start with the negatives first. I will not teach you how to draft a complex loan documents during the next 2 hours. But I will treat you like someone who works in my office, who just came out of law school. I will tell you the pitfalls, what to look for, what to negotiate, and everyone out on the web and in this room will be able to sit in a meeting after the next 2 hours and be able to talk and negotiate a loan document. So if you have any questions on the web or if you have any questions here, stop me. And the people on the web, please type your questions to us and we'll try to answer them during the next 2 hours. Because I'm a practitioner. I negotiate items. So and before I proceed any further, I would like a couple people in the audience to give me your names and why you took this course. Sir?
Mike Hennigan. I work in the real estate acquisition and lending business. You can always learn more.
Okay, you CPA or attorney?
Attorney.
Attorney?
Melinda Pollard, an attorney, and I've been on the residential side of loans and I'm trying to segue into commercial.
Okay. How many years have you been practicing?
15.
How many years have you been practicing?
20.
Okay.
Elon Weiser. I'm plaintiff side employment lawyer. I have no experience at all with these kind of documents and
want some background.
Basically some background.
Okay.
Hi, Thomas Gilbert, also attorney. I started off my practice in California doing commercial real estate loans, but only for a year before all of our work dried up and I moved on to something else, but I've been wanting to get back into it and I wanted to start with this class. Okay,
people say today banks are lending documents. They're not lending money. Banks are like Baskin and Robbins. Banks is like Starbucks to me. They sell money. Today, the prep work is a little harder than it was 25, 30 years ago. But in my opinion, I've had at least 10 clients between the age of 50 and 75 today, or they're dead, who are worth a couple $100 million. But for every loan I negotiated for them, every presentation I made for them, it's the same presentation the bank requires today. It's no different. Everyone who has been extremely successful, like you, they want documentation. And the easiest way to describe it is you have to make a clear, concise presentation of your business. You have to show the plans, the purpose, and the strategy. And there's no shortcuts. I've never seen a successful business person who made money, who was able to borrow money without a clear, concise presentation. Who they are, where they're going, and what's going to happen afterwards. How are we going to pay back the money, and why? Why does Joe Pizzullo have the ability to pay back that loan? Where am I going? And all very, very successful people have a plan. I have in the presentation booklets, it's something that came out from one of the banks. I'm going to spend a few minutes on it. And it gives the 10 tips that I'll be going back and forth with today. The first is open up the net. What does that mean? Well, I've been banking with PNC for the last 35 years. I'll make a presentation to PNC. I want to buy a business. I have $100,000 in the bank. The business is worth $3.2 million. I'll go to PNC. I'll go to the bank manager. What's the problem? You tell me.
I've only got $100,000 on a $3.2 million purchase.
What else? Should he go to the bank manager?
I'm in real estate. There are a lot of intermediaries who cover 40 different lenders.
You understand it.
That's who I go to.
Also, the bank manager does not have that lending ability. He may have $1 million cap. He may have a $500,000 cap. When you're borrowing money, large sums of money, can you have any pride?
No.
It's like trying to get in law school. You apply to 10 schools hoping to get in one. Who should make that presentation? Should it be the client? Should it be the CPA? Should it be the attorney? What do you think?
Client has the most at stake. He makes the presentation.
Who should make the booklet? Should there be any presentation?
That's a collaborative effort. But the
Okay.
client has the final say.
Client always has the final say. The second point that this bank brings up is double check their willingness to lend. And I'm going to jump to number 4 and I'm going to read it verbatim because it happened to me over the last 3 months. It says, don't assume the client bank still cares. Just because your client has borrowed from the current bank for many years does not mean that they will automatically get a new loan. Warning sign that the honeymoon is over, including rise in fees, negative change in terms, or restructuring of current loans even though your client has made a repayment. Another red light is revolving door of the calling officers, or even worse, no calls at law. Find out whether the bank is still lending money in that industry. For example, I'm going to give you a personal example. My son and I own 12 commercial properties. There's a mortgage on 1. 11 of them are free and clear. I financed the first 8 just through an unsecured line of credit. Pay it in, pay it down, get it over with. I'm driving down the shore last July. We were closing the next day. The officer, a new officer that I didn't know well, a new calling officer, as this points out, called me, wanted extra collateral. I said, why? There was no reason for it. He said, well, we can't make the loan. And the Italian side of me came out. I started cursing, I became yelling, and I said, we don't need your money. You asked me to borrow money from you. Goodbye. We made another purchase a couple weeks ago, a short sale. Right, and they told us they're going to do it. A couple of days before, they changed the terms. We paid cash for it. The point I'm trying to make is another officer at that bank grabbed my son. As this article says, they're not lending money on real estate. Their portfolio is not diversified. Even though they lend money, they're not lending money on commercial real estate in the center of Philadelphia today, unless you hit their sweet spot. And we're not going to tie up 5, 6 properties to buy a new one. As I said to my son, we want a line of credit, so when something comes up, we're able to pull on the line and pay down the loan, or buy the property in a couple weeks. The next point they bring up is question the application process. What do they require? My point is, as I said earlier, it has to be precise and clear. On a $3.2 million loan with $100,000 up front, it should be a booklet that is made by the CPA, made by an attorney, made by someone who can write. Have it all when you make the loan application. And find out what the application process is. On the one loan I did on $3.2 million with $100,000 down, the first 10 pages was on the management team who was buying the company. We presented to the banks and the insurance companies that there was no change in the company. It was owned by a major company in the South. It was ran by these three individuals. And these three individuals were buying the company, and nothing was going to change. The same management team was in, and they would continue. But you have to find out what the application process is. They always want tax returns. When you're doing a loan, 3.2 on 3.2, you need personal guarantees. There's no way around it. And it's going to be unlimited personal guarantees. So I have to have personal financial statements. I have to have the personal tax returns. I have to have pro formas. Banks want to know, how are you going to pay back that loan? They want to see the P&L for the next 5 years projected, and how you're going to pay back that loan. Anything else would you put in? When you're going for a major loan?
I'm doing secured borrowing. I have large commercial properties, and I'm borrowing at 50 to 60% leverage. So I've got the entire package describing the building. I've got the financials of the tenant. I've got the rent roll, or the tenants, the rent roll, and the NOI on the property.
Exactly. So what you're doing is you're showing how you're paying back that loan. And if you fall, you're basically telling the bank, if they have a short sale or if they have a forced sale, 50 cents on the dollar they only have to realize to get paid back. So you're telling the bank there's no risk. Something that I've always said, bankers are not risk takers. They usually went to parochial colleges, and they don't take risks. They work their 50 weeks a year, they go down the shore for 1 or 2 weeks, they go back to work, and they wear button-down collars, and they don't take risks. I'm from a large public university, and when my children were young, and we played the Big Five schools, we could tell which schools the attendees went to just by looking at them. They weren't dressed like you. If they went to a Temple game, dressed down, they took the tie off and they opened their collar up. And they usually had khakis or great pants on. But what I'm saying is they're not risk takers. So you have to assume that all risks are covered and show how the risks are covered. And you have to do that in that application process. I usually prepare a binder, and you send it out. And you show from beginning to end how everything about the company. Do not assume that they know your client. One of my largest clients over the years sold packaging. They could have a $60 million commitment from McDonald's. Whenever we switched banks, the hardest thing that we had to accomplish was to convince the bankers there was no signed contracts. Try to tell a banker, a risk taker, or a non-risk taker, that a $60 million order does not have a signed contract. We had to educate them. It's just the way the business ran. Because these orders started back 30 years ago when there were small orders and just continued. They never changed the pattern. And what is my client supposed to go in and say, now I want a guarantee on $60 million? I want it in writing? And if you don't, I have to sue you, or the bank's going to sue you? So you have to educate the client. Also, it's very important in that application process to educate them on who your client's customers are. Are they small construction companies? Is it retail? We just had one where we renegotiated a loan. We showed that my client did steel erection for the largest general contractors in the tri-state area. We showed that all the jobs were stadiums, schools, hospitals. We didn't do homes. They weren't fly-by-night general contractors. We also showed that 70% of the jobs were bonded. And these companies have been around for 100-some years. And not only is the bonding company looking at us, the general contractor is looking at us to make sure we're going to stay in business and finish that job. So the application process is so important. Buffer your file, complete your file. And I enjoy, and something this gentleman said, there's a lot of different backgrounds go into that application. When I do this, you look at the different sciences you learn in college. You have the CPA, you have the attorney, you have the banker, you have the insurance people. And you complete that and you make the presentation. How should you make the presentation? Who should make the presentation? It's expensive. And I very rarely see the client on the front end. It's usually an intermediary. Whether it's someone they hire to get the loan, or whether it's the CPA or the attorney, or both of them sending out the binders. And you try to get interest. If I certain points I want to make today, and one is, don't think the banker is going to be hurt or look upon you any differently because you're shopping the loan. I've never seen them get offended. You want them to know they have to compete for your client's business. My son and I, we sent out 4 or 5 binders on our own loans since we got offended by this local bank, and 5 people have been in our office in the last 2 weeks saying, we want your loan. And I'll get into later, now I'm negotiating the fine points. Something about me, I hate paying large fees. I hate paying for the attorneys from the large firms. I hate paying extra costs because it all comes out of the loan. So I'm negotiating that between or among the banks at this point. The next point that they brought up is avoid recommending the middleman. And what I'm saying is, if you have a client who has a $2 million loan or a $3 million loan, find out what the lending limit is. You don't want to be talking to somebody who doesn't have the authority, who doesn't have the authority to change the terms, who cannot compete with the other banks. Everything gets lost in the communication line as it goes up the chain of command. You want to talk to the person who has the final authority. They will tell you it has to go to a committee. But that person has a lot to say. You want to know who's the primary person who has a lot to say. I was talking to a young lawyer from a major firm the other day, and he said at our firm they have a management committee. It's 5 lawyers. And the 3 young lawyers determines the salary of the senior lawyer, who's the rainmaker. He said they've never given him a number that he wasn't happy with. They said because if he's not happy, they lose their job. Same at a bank. If someone is a rainmaker, bringing in good quality loans, like you said, 50 cents on the dollar, they're protected. There's a good current valuation from a bona fide appraiser. They're happy with that loan. There's no risk. And if you show them all your tenants, they're all decent tenants, the cash flow is enough to pay back that loan, there's not a problem. But you want to compete. So you want to send it out to as many banks as you can who are lending money in that area. You don't want to send out a pamphlet or a package to a bank who's not lending in commercial real estate. There's certain banks right now not lending commercial real estate in Philadelphia. What bank did you end up going with?
We actually go mostly to life companies.
So I'll get that in that later. That's a very good point. I'm glad you have that experience.
I've done them with Aegon, I've done them with Principal, I've done them with AIG.
So what he's telling everybody is that you don't have to go to banks. There's alternative lenders. That one, the $3.2 million loan on $100,000 equity, went to an insurance company. And we borrowed 5 above prime. And I think you're old enough to remember, prime went up to 20. And he was paying 25% interest for a couple years. But we shopped that loan every year. He sold the company recently. He was an unsecured cure loan. And an unsecured loan, you're talking about documents, it's maybe 15 pages. It's a loan, pay back with a couple covenants in there. But he started 5 above prime, and we had to go to an insurance company. Why aren't you going to banks?
Insurance companies' rates are typically lower, they're fixed, they're longer term.
What about prepayment penalties?
Prepayment is yield maintenance, so you have to discount the payments back at U.S. Treasury rates, but we don't intend to prepay.
Okay. But it's a good point. So you're saying, did you shop banks?
We shop banks for construction money,
Okay.
not for permanent debt. I'm looking at a construction loan now. We have shown it to 40 banks through an intermediary. I'm not doing that myself, but 40 banks. 15 bid, 10 look good.
So everyone knows, what are you paying an intermediary?
That's negotiable, half point to a point of the proceeds.
Have you ever paid a fixed rate?
If you're using the good ones, they're not going to do it for that. You have to, they're going to take a percentage.
And you're going across the country?
Yes.
Okay. So the audience understands a lot of loans now are being made out of locale. When I first came up, when I first started practicing, it was rare that you ever made a loan for a Philadelphia business stayed in Philadelphia. Now we go throughout the country. I just closed the loan I have here, I want to talk about later, in Utah. And we got referred to the Utah bank by a local bank. But they have 4 or 5 agents in this area right now lending money. Morgan Stanley's in Philadelphia right now. A lot of New York banks are in Philadelphia. The insurance companies, you have to have enough experience to understand that certain loans, the banks are not lending that kind of money. I just finished the loan, the company that got sold was $60 million. I was told by the lending officer, banks are not lending that kind of money anymore. They will not give a local business, even though there's 8 plants, $60 million today. They said they would have to divvy that loan up between 3 or 4 different banks. But you have to understand that. Next is be time sensitive. Do not have your client buy a business or buy a building, as you said, unless you know the lag time to get approval or have pre-approval. I gave you the example where I was pre-approved orally. A couple days before closing, they changed the terms. And it would have tied up my son and my own hands. And we would not have been able to buy properties in the future. So understand your time lag. For this lady here, you're talking about homes, get pre-approved. When you're buying buildings, you know what you're targeting. And have the understanding and the relationship with the officer that it will be approved. But make sure, once again, I'm repeating myself, they're lending money in that industry. The next is inflexibility is a killer. You have to know where you're going. You have to know what the give and take is. What my understanding is, the more experience the lender is, the more experience the officer is at the bank, the easier it is to close these loans. I'm going to get on, and I'm going to cover a little later, attorney's fees. Because I will always cap them, unless, especially if I'm dealing with a young attorney from a large firm, because they're inflexible. I'm going to be teaching a course here in a couple weeks, and my son's going to be coming here. And he has this saying, he went to Wharton, he goes, they know what's best for them, and they know what's best for you. And they'll tell you, and they're inflexible. And they'll look you in the eye and say, if your client's going to pay the loan, what's the problem? There's zero flexibility. And then you usually start screaming, and you start off the relationship in a bad mood. But I like someone who's very experienced on the other side. I've never seen a deal die or take more than a day if I'm dealing with an experienced party on the other side. If I'm wrong, he'll say, Joe, you're full of crap, move on. And I'll say, no way. I had one last summer. I was down my summer place. They wanted a conference call. I was dealing with an attorney. I Googled her. She was out a year and a half. We had 3 pages of changes. We went through the first page. No, 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 no. And I referred a loan to this lending officer, and he was joking about it. He goes, Joe, you said, I'm leaving. I'm going paddleboard. Goodbye. And he slammed the phone down, and I hung up. There was no reason to negotiate. And then they called me back. I got everything else on the next 2 pages. But I was flexible. There was give and take. But when I heard no, 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 there was no reason for me to review the documents. And I had to make a point. I said, there's no reason for me to talk to you if there's no flexibility. With an experienced person, you know the give and take. If there's a certain business, and I'm going to get in this later, with downtime, you may need a couple months a year for interest-only payments. I have quite a few businesses that have slow periods. And I'll say, during the summer months, we only do 5% of our overall business. So I want interest-only payments during June, July, and August. An experienced guy understands that. A young person such as you never saw it before, you go, no. Have your cash flow equal during the year. It doesn't work that way. Or if there is a problem, I want a cure period. That's normal. Why should you? If we want to cure it, we'll allow you. But you may not be there a year from now. You may be off the account. There's a new lending officer. There's a new chief. We don't have a rapport with you. So you need flexibility back and forth. I've been told by senior lending officers, Joe, you're full of crap, and I'll laugh. You're right. Or I'll say to the lending officer, you know, I can't give up on this point. It's important to us. And you usually can work through the terms in 1 or 2 meetings. There's no reason to have inflexibility. And it happens a lot today because the people we're negotiating with are so bright. They know, and someone taught me back in 1973, anyone can draft the best document in the world. Someone has to buy it. And I'll say that to them. You drafted a phenomenal document. You have protected the bank from A to Z, but we can't sign it. So give me your senior attorney. The next point is, once again, make sure they understand your business and make sure they want to grow with your client. Make sure they want to be a partner. There's nothing more pleasurable than start with a $3 million loan, and as I said a couple minutes ago, 15 years later, it was $60 million. Why? Because they were growing, and they were paying it back. The interest rates went down, the collateral went down, the security went down, the personal guarantees were eliminated. So banks should want to grow with your client. So repeat the 10 points. Open up the net. By that I mean know how many banks you want to send the documentation to. Double check their willingness to lend. Find out whether they're lending money or talking about lending money. Maybe they just have the commercials on the Super Bowl. But they're not lending money. They're making more money by buying stocks or investing their own money than lending money. Question the application process. Know what they want from you. But be prepared. Even before you talk to them, have your homework done. Have your pro formas done. Have your experience done. Have your loan repayment done. Have your collateral appraised. They want to know what is going to secure that loan. Avoid recommending middlemen. By that I mean find out who has the power to make the final decision and make the presentation to that person. I agree with you, the client should be there. The client has to make the final decision. But I usually prefer to have buffers in between. So when you have that final meeting, he or she knows what to say to that person. And he knows what to expect. Be sure the bank is willing to learn, be time sensitive, never fall behind the 8 ball. Have your loan prepared and approved before you make that final agreement of sale. Inflexibility is a deal killer, and be sure they understand your client's business. Once again, I'm repeating myself. There should be a clear and concise presentation of the plan, purpose, and strategy. Show that the business is operated in a clear and precise manner. Now, how do you shop a loan? Who should do it? Should it be the attorney? Should it be the CPA? Should it be the middleman? I've had clients do all three. The clients usually don't have the presentation skills to prepare an application. So I usually prefer that the booklet, the presentation is done beforehand. The appraisals is done beforehand. But banks are going to normally want to do their own appraisals. Your appraisal will get the attention, but gentlemen, what do you do? Do you put an appraisal right in the booklet?
I don't need to, because I'm buying properties that are being auctioned on the open market, and the fact that they're auctioned on the open market in a competitive process almost certifies that the price will appraise.
So they'll accept that number?
Well, they'll use that as the basis for quoting their loan terms, but then they'll do their own appraisal.
They'll do their own appraisal.
Right, but those appraisals usually are drafted and negotiated and discussed enough where they would come out at the right level.
And cap on fees. Appraisals can be expensive. I've seen them anywhere from $2,500 to I've seen $10,000.
You know, the last deal I did is $50 million, so I'm not going to be sensitive on the appraisal. I'm more concerned about origination fees, having reasonable attorney fees, and loan intermediary fees.
The fees could bother you also then?
They don't bother me as much. I buy for a REIT. They would bother me a lot more if it was my own pocket. And I'm reasonable in the context of a corporate transaction. I know people have to make a living. If they're not gouging me, I'm okay paying them.
Okay, I'm going to ask you a question then. If you have to negotiate the origination fee versus the attorney fee, what should you take off the table first? I'll repeat that.
I'd like to make a comment first on that.
Okay.
Coming from a legal background and working on the business side, I find that, and lawyers get a bad rap, but I find that lawyers do most of the hard work to get a deal closed.
But if you want to close that loan, which of the two is going to hinder the loan being closed?
The origination fee is negotiable to a certain point, but you're not going to get, well, no, I'm sorry, the origination fee with the bank, I'm going to negotiate that hard. That's total profit for the bank. You can make them give that up completely, or...
Let me ask you a question. Are you going to offend somebody through the origination fee? Are there any bonuses being paid out of there?
Am I going to offend someone? It's all negotiable. As you said before, the banks expect to compete. They're not insulted by you negotiating. You can play one off the other, and you can move the quotes dramatically through the shopping and negotiation process.
I've been told by more than one banker that the lending officer gets points on the origination fee. So I have many times I will leave the origination fee on the table, but bang the attorney fee. Especially if I'm going to a large firm and I know someone a year out of law school is going to draft the documents and pound me hard in the negotiations. I've also found, and I've done this on the 5 banks that I'm negotiating right now on my own loan, it can be done in-house. They have internal attorneys that can draft the documents without an attorney fee. But it's in the city of Philadelphia, you have give and take between the banks and the large law firms. And I could see a $25,000 legal fee. So if I have to negotiate a $25,000 legal fee down to 10 and leave a $25,000 origination fee that I know that lending officer is part of that's going into his pocket via bonus at the end of the year, I'll leave that on the table.
I'm thinking in different terms. I'm thinking on a $25 million loan, a point origination fee is $250,000.
Okay.
So I'm not so concerned about the lawyer making $25,000.
I'm not either. On that, I'm not.
I'm not. So that frames my response.
Yeah. I had the one I'll get into a couple minutes. He started a subprime loan lending company 5, 8, 9 years ago when they were big. And we sent out like 30 brochures. And the middleman received $100,000 once we closed. It was a $20 million loan. So, I mean, he was happy, and we didn't negotiate that. But sometimes, what I'm saying to you is that I try to keep the client back out of this and off the table until the loan's ready to be consummated. First, you want to get as many term sheets as you can, commitment letters as you can. Also, in the application process, promotional material, everything about the clients, the executive summary, business and personal tax returns, and a complete loan application. And the most important thing, don't be offended. Your client cannot be offended by being turned down by 9 out of 10 banks. As I tell clients, it's similar to Scott Boras, who's a baseball agent. It only takes one bite to close. And I've seen clients with zero net worth get major loans with the right presentation. They were turned down by many, many, many banks, but it only took one bank to bite. Someone had to take an interest in it. And they cannot be, it's like someone going to a foreign medical school. It's like someone going to a Class C law school. You still can work and practice once you're back. Once you get that loan, the first loan, and you are successful, you can continue. It only takes one bite. You cannot be aggravated, and it takes all the sciences to be able to close a loan. The negotiating factors. What you're looking for once you make that application is a commitment letter. And many times, clients, once they get this, sign off. This is just starting the process. This is the second step in the process. This is what you're looking for. It's a binding document. Probably when your client signs it, he has to submit a check. Anywhere between $25,000 and $50,000, a minimum. This is where the attorneys start working. This is where I start calling in the CPA and try to work with him to make this concise and get what I want. It's like a letter of intent when you're trying to buy a piece of real estate, or you're trying to buy a factory, or you're trying to buy a commercial store. People say, why do I go to the bother? Why should I spend time going through a commitment letter? It's not the final documents. Everything in the final lending document comes from this. Everything flows from the commitment letter. And I've never seen a loan finalized without a commitment letter. And try to get more than one. When you receive a commitment letter, it's good for 10 days, or maybe 20 days. They'll always extend it. Take it to different banks. When you get a commitment letter from an insurance company, you take it to different banks or different insurance companies?
It works a little differently. We typically get detailed term sheets
from
a handful of potential lenders, and then we play them off each other, and we make a choice, and then we get a more formal document.
So the listeners and viewers understand. Loans are just not made by banks. House loans are just not made by savings and loans. You can have private investors. You can have hedge funds. You can have insurance companies. I usually go to insurance companies when it's a non-bankable deal. But like you said, sometimes the terms are better. I just switched the client from a major A1 bank in Philadelphia to a Utah bank. It's a Class B lender. By Class B, I mean it's not bankable by a Class A lender. It's not a normal banking relationship. But it ended up, it's cheaper. Why? I don't know. But it goes back to those 10 tips. The bank's out of that market. One of our local banks is shoving commercial loans out of the bank, just making the terms hard. Where there's a financial breach, a financial covenant breach, which I'll get into, they start pestering you. And then they put it in workout. Nothing is worse than a workout. A workout artist, a workout officer is like a drill sergeant. They just make life miserable for you. So we switched to a Class B lender out of state. The terms are easier. My client's been with them for 7 months and have not had a slightest bit of problems with them. The rate's less, they're borrowing more, and it's a Class A relationship. But as I said earlier in those 10 points, and I said I'm going to go back, banks sour the relationship when they want out of the market. Let's just say 70% of their portfolios is in center Philadelphia real estate. They want to get it down to 40%. So it'll make life miserable. You forgot to send your financials in last year. You forgot the last 3 years also. But this year, they're jumping all over you. If you don't have it in within 20 days, we're going to call your loan. And they call up your wife's yelling because she personally guaranteed, and it's all the bombs and whistles went off. They would have never done that 2 years ago. But that lending officer has been told they have to clean out 20% of the portfolio. Where they want to go in something else. I compare it to a college coach. When they try to recruit a player, they beg him to go to the school. Once he's in there, they're screaming at him, cursing at him, yelling at him, and he's a third-class citizen. But when they want you in, they're begging you. You will go to their super box. You will have tickets at the 50-yard line for the New York Giants game. They'll take you out to dinner. They'll beg you to come in. But now, all of a sudden, the relationship's soured. So some of us, and you have to have the experience to know their alternatives. You have to find the right middleman. And how do you do it? Many times clients, like car dealers, they all know one another. Even though they're competing, they have respect. If your client, if the car dealer 5 blocks away or 10 blocks away or 5 miles away won't tell him who he's lending from, just do a UCC search on him. For $30, you'll find out who he or she is borrowing from. Or just call up a competitor. Once again, call up a competitor and ask who are they borrowing from. How is the relationship? Will they introduce you? I mean, there are times lenders will come to my office and beg me for loans. And they cannot disturb someone like me because we run a lot of money through that bank. Our practice probably has open 75 estate accounts. Anywhere from $5,000 to $50 million could run through that estate account in any 1 year. So if I'm disturbed, am I going to continue to do business with that bank? When we have trust relationships, and I'm the one who recommends to the client what bank is the better trust company in the city of Philadelphia. And it's based on service. As I say, what you would say it's similar, I want service. I'm not looking for kickbacks. I'm not looking for referral fees. It's illegal for me to take it. All I want is service. So when I call you, I want you to pick up the phone. Can you make this loan? Or you can. Here's the documentation that you need. And I want respect back. Tell me yes or no. Don't beat around the bush. My client's time sensitive. It's a good client. Or it's a risky client. Or it's a client that had a bad year, but they'll fall back. They always have one bad year every 5 years based on the economy. But they've been in business for 30 years. And the collateral's there. Tell me yes or no. Same with a trust. And we all will tell you there's always 6 reasons to give a loan. And there's maybe 7 reasons not to make the loan. Tell me yes or no. When I call a trust officer up for a distribution, if there's reasons to do it, okay. If there's reasons not to do it, okay. Let's make a decision and allow it to work. And that's what we're looking for, flexibility. And tell me what I have to change. But you're never going to get that change if you're dealing with the lower person. You're never going to get it from the bank manager. You're not going to get it from the first junior lending officer if his cap is $5 million. He may be going in there selling it, but you want him to go directly to the person. Have you ever dealt with hedge funds?
No.
No? They'll want to...
I've dealt with CMBS, which is probably nearly as painful.
What do you mean by CMBS?
Commercial mortgage-backed securities. Banks that are making loans to securitize. And they're extremely strict in their terms. Documents are very tough to negotiate. The recourse, the guarantors they need are heavily negotiated. The loans are then sold into a securitization, which is they're all held by a trust, and there's a servicer who administers the loans, and the servicers are completely inflexible in terms of enforcing loan terms. Whereas the life company, you're dealing with a loan that's on their balance sheet, and that there's an officer in the life company dealing with it. You can work a one-to-one relationship. Once you do a CMBS loan, everything is sold to a third party, and you lose all control.
But why? You're always dealing with an individual.
You're dealing with a third-party individual. You're not dealing with the officer you struck the relationship with who made you the loan. So you strike a relationship up with
why would
Morgan Stanley, and you have a relationship with a loan officer there.
Why would they want to threaten that loan?
Morgan Stanley sells the loan.
No, but once it's sold, why would the buyer or the assignee?
And any technical infraction during difficult times, there's going to be no flexibility.
Why? They don't want the security back.
One reason is they admit they service thousands and thousands of loans, and they've got tons of work to do, and the easiest thing to do is being flexible.
Okay. It's funny because I told you a half hour ago that I bought a property at a short sale around 4 weeks ago. I made the offer September 2011. It was a property that someone bought for $975. I made an offer of $550. September 2011. I was told the same thing. You can't find the person. Everything takes time. Once I got past Labor Day, I was in no rush because it's a shore property. I read in somewheres that now there's a new federal law that if everything's in, they have to respond to you within 30 days, as of last July. If more than 10% are in default by that lender, there's $1 million federal fine. It's a federal act.
I suspect that's for residential properties,
Yeah.
because they're protecting consumer.
So,
In the commercial world, all the gloves come off.
no, but I emailed the attorney, Joe, you don't know what you're talking about. We went back and forth for like 3 hours. I got accepted at 3 o'clock, and it's closed. But they all say they can't reach the person. We're busy. And someone has to clean up the industry. I mean, the subprime industry went down because of that. And most of those loans were good loans. When they finally bankrupt and liquidated those loans, most of those loans got paid off. The public thinks 10 cents on the dollar got paid off. I've had owners of subprime companies who bought the individual loans at 40 cents on the dollar and collected 95 cents. So, I mean, whether it's commercial or residential, they're collectible. I found insurance companies, I found them a little more terse than local banks, because local banks do not want to take over a loan. They may threaten you, they may yell at you, they may scream at you, but they very, very, very rarely will take the property back. I mean, as I said earlier, most those officers in the fallback area, they're like drill sergeants. They scream, they yell, they threaten, they're going to take you to a judge. It's like, do it. I've never seen when the company came in, their bank came in and said, I'm taking over that loan, not give my client 3, 6, 9, 10 months to leave the bank. I would usually say, give me time. I need time. I was flexible. I'll work with them. But at a certain point, you have to put the line in the sand and say, you're not taking over the business. We hear you. We're leaving, but we need time. You know and I know you do not want to take over that factory. You and I know you don't want to own a factory in Camden, New Jersey, or Westfield, New Jersey, or Cape May, New Jersey. You're not in the business of managing properties. You don't have anyone there to do it. And if you do, it's going to be embarrassing for everybody. So give me 6 to 9 months to leave the bank. And you have to go to Class B lenders, or you have to go insurance companies, and you start all over again. And if you need an extension further, you be honest with them. But once again, you're looking for this letter. And let's spend a good half hour on going through what's negotiable and what is not negotiable. First, you want to know if you want just a term loan. A term loan is one, I borrow $1 million. It's paid back, amortized over 20 years with a 5-year balloon or an 8-year balloon at X dollars of interest. Most clients, when they have a commercial business, will have a term loan and a line of credit. A line of credit you borrow when you need the money. I've seen the line of credits without an asset-based backing. I've seen it with an asset-based backing. By that I mean they borrow off receivables, they borrow off work in process, they borrow off an inventory. Otherwise, I have one here, they borrowed $3.5 million, and it could go up and down. The problem with borrowing just up and down without an asset base, most banks will require you to clean it up for 30 days during any fiscal year or any calendar year. By that I mean you have to get it down to 0. It sounds great that you don't have to do the monthly reporting. You don't have to certify what your receivables are. You don't have to certify what your inventory is. You don't have to certify what your work in process is. It's much easier. But most clients do not have the funds to pay it down to 0. You're going to ask me, why do you borrow if you're not going to pay it off? Why do you think? You're new here.
You don't have it.
Why?
It's as simple as that.
Why don't they have it? I bought a business for $3 million. 5 years later, why am I now borrowing $8 million?
You want to grow.
What do you mean by that?
You want to turn that $3 million into $10 million.
You have 3 factories now. Before you had 1 factory. Or before you had 20 employees. And you're doing $8 million in business. Now you have 100. And you're doing $20 million in business. You have a greater need. You're always buying equipment. You're always renewing equipment. You have a greater inventory. You have greater receivables. One of the negotiation ploys that I negotiate all the time, I get it sometimes, I don't get it other times. I have 0 in my checking account. Why? Why does my at the midnight tonight, my checking account shows 0? And I negotiate that. I want it.
You want, I don't know.
A 0 checking account. I brought in today $100,000. But at midnight tonight, my checking account was 0. And I insisted on it being 0.
Maybe tax reasons?
Putting into the business.
No. What do you think?
No interest?
I'm paying down my line of credit every single day. I want to 0 every cent that I bring in. I'm throwing it into my line of credit. And tomorrow I'm going to borrow again. I'll save the interest for a day. Say you're borrowing $15 million. By the end of the year, that's a sizable sum of money. Banks don't want to give that to me. When I go through this commitment letter, that's part of the negotiation process. I want all deposits, I want my account swept at the end of the day and lower my line of credit. So I'm starting off with a lower line the next day. And it's strong. You don't think about it, but you learn. They have the flexibility to do it. They don't want to do it. On these term loans, we spoke about it has to go in the commitment letter. Prepayment penalties. Strongly negotiable. Term loans, it's rare. You're going to have a prepayment penalty. Have you ever seen a term loan?
So
5-year loan without a prepayment penalty?
no, you can sometimes get them to just stipulate a percentage,
A
diminishing
decreasing percentage.
decreasing percentage for the last 3 years, but it's always going to have something. They want to put that money out for that term, and they want to be compensated if they get the money back, and they can't invest it at the same rate later on.
That's what they tell you. And I usually try to get the one I just closed, the one I have with me right now. It was a Class B lender, the Utah lender. And I have in the document that if I take it out and put it back to the original lender in the next 3 years, they'll waive all prepayment penalties. But it had to be negotiated. Lines of credit, floating rates, I usually get them to waive it. If it's a floating rate of interest, I can get a bank normally to waive it. But it's like someone, I spoke to this old landlord in Philadelphia. He has probably $80 million of real estate. And I said to him, I said, Leroy, I hate changing tenants because you have to put new carpet in or new hardwood floors, you have to paint the place. He goes, Joe, I have a prepayment penalty. If they leave any time during 3 to 4 years, I make them pay me a penalty for the renovation. I said, I've never thought about it. It's just like a bank. But you have to negotiate that. That is a business term. You can negotiate through the young lawyer, but he does not have the authority to waive that. I'll usually take this letter with computers and mark it up and show them all the changes. Or I'll just do a separate letter with all the changes and go down them. But the prepayment is so important. If you take anything out today, try to avoid swaps. The interest rate is much less. I've never seen a good swap. I've been practicing 38 years, and I've never seen a client understand it. Very, very, very few commercial loans go to the final date. And when they try to prepay it, the penalties can go in the hundreds of thousands of dollars. I find there must be a bigger perk for the lending officer because they push the swaps. But I just had one, and it's a disgrace. It's a local bank in Philadelphia. I had someone who had 20 residential loans for 20 different properties in a shore place. The lending officer from this bank got him to put them all together, commingle the loans into one loan with a swap. Now he just bought a major liquor store in our area. He needed $3 million. Tried to sell them, and it was like a $300,000 swap fee to prepay them. And to calculate it, you need a math degree. You need an advanced math degree. So if you take something with you today, before you put your client into a swap and you're saving 2 points on the loan, make sure your client understands it. Make sure he understands the drastic prepayment penalties if he's not going to hold the loan until it matures. This one client, they were putting the money in escrow. He was making 1/8 of a point interest to avoid the penalties. They allowed him to sell the property, but he was not paying down the loan. It was being put in an escrow account just sitting there. So have you ever had clients with swaps?
I have not personally done swaps. We have a deal in house now where we have one of our guys pitching to take a loan with swaps, and people are very leery. We have used swaps in the past to hedge a portfolio. We started out as a lender to hedge a portfolio of loans, and when the markets crashed and rates dropped,
Oh, yeah.
you're talking you could lose tens of millions of dollars on these swaps, and they behave in unpredictable manner.
It's like clients with defined benefit pension plans this year. Because of the drop of the interest rates and the drop of the treasury rates, clients are getting letters from their actuaries. They're $300,000 underfunded, and they have to put an extra $150,000. We just had client, they're having problems with their bank, and we had to make a profit this year. And they did make a profit, but they got a letter from their actuary that their accrued liability on their defined benefit pension plan is an extra $300,000. So now they have a loss of $50,000. And we're going to the bank saying, but we didn't lose money. It's just a drop in the interest rates. But nothing you could do. And same with the swaps. I mean, clients are staying away from DB plans, defined benefit pension plans. And I usually recommend, unless they fully and completely understand them with the swaps and use at least 10 variations, what's going to happen 3, 5, 7 years with different interest assumptions, what the prepayment penalty is, stay away from. They're too complicated for the normal client to understand. I've never seen one work out. I mean, between you and I, because we've both probably been around 50 years, I've never seen a client prepay a swap and not have to pay a major penalty, even in good times.
I can tell you our CFO at the time was an MIT engineer. Even he was shocked by what was going on.
It's amazing. And you know, you can yell and scream, and then you end up getting into litigation with the bank that they did not fully explain it to your client. And if there's a swamp, I mean, the one I have right now, I'll get into later with the attorney opinion. There was no attorney opinion in the file. And he bluntly told him in an email, do not go to your attorney. You don't need an attorney to close. And it's a swap. And this client, I feel bad for the client because I believe, I said to him, if you left it the way it was, you had 20 different loans. And you could sell each one, pay it down with a residential loan without a penalty. All of a sudden, you have a $300,000 penalty because he just wanted to walk into the bank and pay him cash, pay off the loan.
Well, the equally important, or even maybe even more important observation there is never cross-collateralize your properties under one loan if you can avoid it, because one property going bad can take down the whole collection of them.
Exactly, and we have one right now. What you're saying is, and especially on any of these young attorneys who were talking about a business loan and a real estate loan, what you're saying, do not cross-collateralize them. We had one with a swap recently with a bank, and we brought in another bank, and I could not see where the real estate loan was cross-collateralized with the commercial loan. And I said to the client, I don't see it. I don't see anywhere in there. And it's funny because the clients, I got an email on the train ride up here on the new loan lending document because the real estate loans do. And that had a swap feature. But it matures now. They have something in there that if defaults on the commercial loan, it ties up the business loan. You try to get them separate. And that's all part of the negotiation. And you have to be upfront with them. The real estate's separate. And the problem with that is, and I've seen it 3 times this year, where because I'm older now, a lot of clients are selling out. And what you're saying is, a lot of times they sell out and they pay off, they sell the business. But the way you sweeten the deal is you lease the real estate for the next 5 or 8 years. Say the client wants $8 million for his business. The business is worth 5, the real estate is worth 3. The buyer may not have the money to buy 8, or he may not be able to get the financing. So you'll sell the business for 5, the client will retain the real estate and lease it for 10 years. And it's a sweetheart. And in 10 years, the property's worth more. And he has the cash flow, and he has the real estate. But if you have the cross-collateralized, as you brought up, when they pay off the business loan, the bank gets paid off the real estate loan. And the bank may want the money, especially if there's a nice penalty in there. So you try to keep them separate. I have one right now where the client's negotiating, and we can't get the number. So I said, take the real estate out of the deal, and you have the number, and have them lease it. If you can get $20,000 a month for 5 years, and then the property's in a great neighborhood, it's only going to go up in value. It's right next to the turnpike. I said in 5 years the property will be up 20-25%, and it'll be a sweetener to the deal, and you can close the deal. But these are all negotiating factors. The interest. What's the difference between LIBOR and prime? Is there a difference?
I don't know.
Is there a difference? Back to you.
Prime is the rate that the bank set. LIBOR is the London Interbank Offering Rate where money changes hands in Europe.
And which one's normally cheaper?
LIBOR is dirt cheap.
You try to always negotiate off of LIBOR. I mean, most bank loans will negotiate the interest rate. I'm going to go into, in another half hour, how to sweeten the deal to lower the rate. But you have to give something up. You always have to give something up. Lower loan fees. As we spoke about earlier, the lending fees, I try to negotiate. I try to look at it as a package. When you have a normal loan, you have a lending fee, you have audit fees, you have attorney's fees, and then you usually have financial covenant fees if there's a breach. And everything costs your client. And the type of audits that are required, the type of statements that are required, everything has a cost. And the bank's going to want as much as they can get. There's nothing worse than being at a Center City bar when they come in on a Friday night, drinking their light beer, bragging about what they got, and they don't know who's next to them. But they'll brag about it, how they put you to sleep. Lending documents are negotiable. I've seen large car dealerships. Guys are worth millions sign the papers as is. They trust their banker. And then when something goes wrong, you'll see a for sale sign or a vacant car dealership. And you'll wonder why. And these are bright individuals. If you have a problem with the loan, negotiate the amortization schedule. Very few banks want longer than an 8-year term or 10-year term. Have you seen anything longer on a commercial loan? They would like 5 years.
Most is either 5 or 10. Unless it's construction, then it's 2 or 3 with an option to.
But try to get it out. Get the amortization. You'll have a balloon after 5 years. You'll have a balloon after 8 years. You'll have a balloon after 10 years. But get a 20 or 25-year amortization. The bank's still making the interest. The loan's not going down. They still have the principal repayment. But it's all negotiable. That's when you need the cash flow in there. As I said earlier, talk about interest rates. Once the interest rate's established, then you have to see certain clients can't pay that interest or can't make principal payments a couple months a year. Negotiate. Talk it through. Understand the document. That's where the give and take is between me and the CPA. So critical are financial covenants. Financial covenants are where the NBA-backed broom guys have your clients squealing themselves and tell them when a loan may have problems. It does not mean your client has never ever missed a payment. Does not mean your client does not have the collateral. Does not mean your client does have cash in the bank. It's just certain financial covenants. What are some of the covenants? Give me a couple examples.
In real estate, debt service coverage ratio, you might have to maintain, 1.5 debt service coverage ratio, which means that your income is 1.5 times your combined principal and interest payments. So you lose a tenant, you may still be getting enough money to pay the loan back, but you're now at 1.25 times the payments, and you could be in trouble for that.
And they'll come in. And once again, I've seen it where they want to get out of that industry or want to get out of that market. And they'll use that to call it on. Your client's current on their payments. The collateral's there. They have the personal guarantees. And all of a sudden, they're threatening your client. What I normally do is I review those covenants. When I get this term sheet or commitment letter, I review it with the CPA, and I have to know what the cushion is. Like what you just said, if I lose a tenant for 3 to 6 months, am I still within covenant? If I go down 5% on sales, if I lose a major customer, let's just say, and I'll get into this a couple minutes, what if I lose my biggest customer and it's 10% of my gross? Will I be within covenant? What if I lose a lesser covenant customer, which could happen at any time? Will I be within covenant? If you're ready to breach a covenant, it's always better to go in, hat in hand, and warn them and tell them. The worst thing you could do is like the child who dropped the cookie jar, is wait till your mother comes in and your mother sees it on the floor. They hate that. We usually tell clients, go in and talk to the banker and tell the banker you're going to be out of covenant. Normally, you'll have to pay a fine. You'll get a waiver, and they'll want $5,000, $10,000, $15,000, $20,000. Have you seen it otherwise?
Not in my experience, but you're in a different, I'm not doing business loans.
Yeah. But you usually have to pay a fine. You'll need a waiver. You'll pay a legal fee to draft a 2-page document, and you'll be within covenant within 6 months or a year.
You could probably negotiate in your term sheet or your commitment letter up front a cure period.
I'll get in that. Yeah, most breaches, what you're saying is, and we still have it in Pennsylvania, is a confession of judgment. Confession of judgment is a nuclear time bomb. In Pennsylvania, it's legal in commercial documents, not residential, that if I'm in default of a loan, the bank can be my attorney, confess judgment against me. By that I mean, you have a judgment of record. They can tie up my bank accounts, tie up all my receivables before I'm even given notice. That's called a confession of judgment. If I'm in default and a financial covenant is a default, in every loan document you have events of default. And it tells you this when you're in default. So if I'm in default, they have the authority to walk into the prothonotary office, confess judgment against me. I agree that I'm in default and they have a judgment. They can walk it over to the sheriff's office, and the sheriff can go attach or garnish all my bank accounts. And that will happen before I'm even given notice. I rarely, if ever, allow that. But I'll get this kid from Harvard Law School saying to me, if you're not in default, why do you care? If you're paying the loan back, why do you care? And I've had people say that to me. What do you care? It's non-negotiable. And I'm also waiving trial by jury, because they don't want for me to get in front of a jury and explain to a jury in layperson's terms what happened. This tenant moved out, and I'm in default of a financial covenant, but I paid all the money. I never was one day behind on any payments. He went in, tied up my bank accounts, confessed judgment, and closed my bank accounts. I'm out of business. And that happens. So you always have to start with no confession of judgments. Then I will also try to minimize what the guarantees are. They're always going to start with a personal guarantee. And it depends where you are. I have as many loans in my office with a personal guarantee as I have without a personal guarantee. It's purely negotiable. And I'm not going to allow that other attorney to tell me what's good for the bank and what's good for me, because they'll always threaten that guarantee against me. On a lot of startup companies, you start with personal guarantees. They'll start with a husband and wife. As the relationship grows and the business grows and the equity grows, say I have a 4-year span where the net worth of the business increase. Good clients leave the money in the business. The clients who grow and sell their companies leave the money in the business. They take a nice salary. They take a great T&E. But they allow growth inside the business. Then I'll get a fallback guarantee. A fallback guarantee means I'll guarantee part of the loan. I'll say to you, John, it's a $5 million loan. We have receivables and inventory. So what's your risk? What's your biggest risk? $1 million or $2 million? Tell me. If everything falls, what is your risk? And if I could talk to a senior attorney like that, he'll understand. So I guarantee $1 million or $1.5 million. I've also, and you have to use your creative mind to negotiate the guarantees, especially the fallbacks. I've also said if there's a $5 million loan, 2 shareholders, your risk is $1.5 million, okay, each one will guarantee $750,000. It's not joint and several. Each one will be a separate guarantee. I've also negotiated them, even with the separate guarantees. I want a minimum commercial reasonable time, which will never be less than X months, say 9 months, to liquidate the collateral before you go to the commercial guarantees, personal guarantees. I'll repeat that. If there is collateral, by that I mean receivables, cash, inventory, equipment, M&E, I will say, before you fall back on the personal guarantees, you have to follow the UCC. Remember, second-year law school, commercial reasonable standards? You have to follow that in liquidating the collateral, which will be a minimum 9 months before you fall back on the personal guarantees. Because it's much, much easier, think it through, for the bank to grab Joe Pizzola's bank account or his investment account and say, you go liquidate the receivables. You go liquidate the M&E. We're not in that business. And remember I said, banks do not want to operate businesses. They do not want to operate apartment houses. They do not want to operate any kind of factory or construction company. So what do I get out of it? Think it through. I get reasonableness. If I have to leave the bank, I have enough time to work with the bank, find another bank, and let's just say, what's it, May? Financial statements are just coming out now for year end. Let's just say PNC or TD Bank or Morgan Stanley told my client to leave in October. I'm having a bad year. Do you really think I can leave the bank in October without financials? They're going to want current financials. They're going to want certified financials. They're just coming out now. So I have to get the certifications, then I have to send out the packages. No bank will take over that loan, even a B lending, a B lender or an insurance company without current financials. And there's no way I could rush them. So I will say to John from TD Bank, I need time. What do you need? Probably the next September. Whoa, I need it. Let's go through it. I mean, we can yell, scream, and yell and curse at one another. What good is it going to do? Let's go through it. The financials will be out if we rush them, April or May. And once I get it, it's going to take me at least 120 days to close the loan. It's going to take me 60 days to shop it and 60 days to finalize it. So I need that time. And then I have to go through, is there enough collateral to satisfy them? I did one recently where the owners had to put in $250,000. Or they put $250,000 back as cash collateral. Because I said, what's the risk? That's how you start it. Look at your risk. Look at the amount of the loan and look at your risk. If you take all our receivables, you're covered. So where's your risk? There is none. And you can't put 120 people out of work. At least 5, 6 banks will take this loan, but I need time. I need time. And that insult to injury, what you just said about the interest rates falling, they had a profitable year. Then the DB plan, interest rates caused the loss. It's beyond their control. I was listening to a disc jockey this morning. He spoke about a tragedy. He said a tragedy is something beyond your control. I mean, the client had no control over interest factors on a defined benefit plan. Same with a swap. It's something you don't have control over. It's done down in Washington. It's not done here. And it's issued by IRS rates. So you're talking about cure periods. If I ever have a default, I have X days to cure it, or the time period that's necessary to cure it if I'm actively curing it. Certain defaults you cannot cure within 30 days. Say it's a health violation. On a building, just say it's a code violation. I know someone down Cape May who has a fire sprinkler violation, but he's actively fixing it. But if I get that letter, you got 10 days to cure, I can't cure it in 10 days. But did I hire a sprinkler company to fix it? Am I going for my permits? Is the work being done? Okay, I'm curing it. So the wording is so important. Some banks will come to me and say, Joe, I'll give you that right to cure, but not more than 3 times every year, or 2 times every year. I can't be sending letters out every 30 days. Okay, negotiate. Be flexible. So when you look at it with the breaches, what they'll usually be inflexible on is money defaults. I normally get them to give me a notice period except money. But I usually fight for that because I say, what happens if the check got lost? And I'll say, you know, we'll have the money wired at any time. So I need some flexibility on that. They're usually insistent, if it's money, no. You can get it at times, but if it's something that's beyond money, a paper default, a financial covenant default, you have time to cure it. 30, 60 days, unless it cannot be cured in that period, but you're actively curing the event of default. Any questions? On the loans, especially if startup years, they're going to control the distributions to shareholders or to members. There'll be limits on the salaries. If it's an S corporation, for the younger attorneys, make sure you allow tax distributions. If there's paper profits, they're going to need money to pay the taxes on money left in the business. It normally will not be in the lending documents. You better think it ahead of time. Think in advance. Draft it. Defaults, depending on the client, I usually say to the bank, I want it based on objective standards. Banks are going to try to get in there as also reasonable amounts as in the bank's sole and absolute discretion. I will never allow that. If it's a bad client or a client with financial difficulties, I'll allow reasonable discretion. But I usually, I'll say to it, like when I draft an employment contract, if you're going to fire my client, I want it based on black and white. Did he steal? Did he plead guilty to a felony? Was he found guilty of a felony? Something that's black and white. I usually do not want it to the bank's discretion, because all of a sudden they'll find in their discretion, especially sole and absolute discretion, that you have a breach and that they're not secure. I've seen it also. The bank does not feel secure in their sole and absolute discretion. What does that mean? It means you don't have a lending. You don't have a term. You don't have an expiration date. It means they can call a loan at their sole and absolute discretion. We spoke about lower attorney fees. Many of these documents can be done in-house. They will send them out. It's quid pro quo between banks and law firms. And if it is sent out, I will always place a cap on the attorney's fees. Because, once again, I'll repeat myself, you don't want a young attorney drafting documents, being so hard on you, knowing that that fee went up from $5,000 to $20,000. And I've seen $35,000 legal fees on a couple $1 million loan. And I'm dealing with a young attorney. And I know that person's working at 9, 10, 11 o'clock at night on your documents, reading word by word by word. And experienced attorneys, I've rarely, if ever, seen a loan document fall based on attorney's fees. When you put up collateral, I try to limit it. By that I mean, what if you're expanding? What if your client has a factory? He needs $1 million press. The bank will not lend the extra $1 million. What if you lease it? It's after acquired property. The bank doesn't have it now. And I'll usually put inside the document, as long as we meet our financial covenants. If we present this to the bank, they have 5 days, 5 business days, or 10 business days to accept it or reject it, or otherwise we can go to someone else. They don't have the property now. We're within financial covenants, so we can acquire the property, or we can borrow the money from somebody else, whether through a lease purchase or other type of creative financing. But try to limit the collateral, especially if your client's growing. Because if clients are growing, like I'll give you an example with the cups. If we're going to get another $25 million of cups in our factory, we need equipment. What if we're within financial covenants and TD or PNC or Susquehanna doesn't want to lend the money to us? They don't have that collateral now. So if we're going to borrow the money, get the equipment in, it takes us 9 months to get the equipment in, we have to be able to get the equipment to expand. The bank has to be our partner. They're not any more at risk. We're going to have an extra $15, $20 million of sales. So why can't we have that property? They cannot work with us, then we don't want to start the relationship. But, saying it again, has to be in the commitment letter. The terms of the loan. Most asset-based loans, they're all over the place. By that I mean receivables. You have to work with the bank. I have one right here. It talks about eligible receivables. There are 3 exceptions to eligible receivables. By that I mean the accounts receivables that are less than 90 days old. But then the bank takes 2 exceptions. I have another bank. We talk about eligible receivables, and I have 18 exceptions. Every one of these were negotiated. This one gives 80% on the receivables. This one gives 85% on the receivables. This one has 3 exceptions. This one has 18 exceptions. The bank took back anything that's bonded. Anything, if any customer is more than 20% of the receivable. The bank also took out if any receivable that's less than 90 days old, if 50% of the total receivable from that customer is more than 90 days old, they took it out. They took out all retainage. In this industry, the client had $8 million of retainage. They will not lend on it. So what I'm saying to you is, when you talk about a receivable, an eligible receivable, you have to understand what the receivable is. What are they lending on? When you get the term sheet, not this final one, not the commitment letter, it'll show receivables less than 90 days old. But when you flush it out, you have to understand what that receivable is. Because most clients, as I said on this one, the client borrows 85 cents on the dollar of any receivable less than 90 days old. This client, we had $12 million receivables. The eligible receivables were $6 million once we took out the exceptions. And that is purely negotiated and depends on the relationship and the power of your customer. Inventory. This client has the lesser of $250,000 or 50%. We fought that. The bank would not budge. All the inventory is metals. We told them we could melt it down and get more than $250,000. This client got $750,000, the lesser of $750,000 or 50% of the value of the inventory. So once again, I had to go through that and negotiate it. And we took away the cleanup because the client had a problem cleaning up their loan once a year. We made it an asset base. But when they came back, what we thought was $12 million of receivables less than 90 days old came to $6 million. On that 20% rule, we got it for one customer who's a phenomenal customer, is a general contractor. We got that up to 30%. But that was give and take, going back and forth. We could not get the number that we needed to borrow. And we told them, we can't get it. This loan expires on June 30th. If they tell us we have to leave, we have until October 31st to leave the bank. I made them put in this waiver that we had 120 days notice. Where'd that come from? I said we need 120 days. We'll get the financial statements now. We'll know where we are. We'll talk to you for 30, 60 days, whether to renew it. And then we'll know whether we have to shop the loan. And we need time to orderly leave the bank. You just cannot leave the bank. For those of you on the eligible inventory, the eligible receivables, if your client sells to foreign foreign territories, companies in foreign territories, you need an exception. Many banks will not lend money if you're selling products overseas. If you're doing governmental work, you need an exception. We have a client who sells to military throughout the world. So that loan, I had to be prepared to get an exception. Normally, then when that comes, the pre-printed document you'll get from the bank will have that not as an eligible receivable. First, it's a governmental work. Secondly, it's a foreign country. They don't want to have to go overseas and sue. They can see them going in Spain. They don't want to go to Spain to collect $5 million in case the loan defaults. But these are exceptions you as the attorney and CPA have to understand. And it starts with the commitment letter. As I said earlier, for those of you who are going to borrow money from large amounts, many local banks will not want to hold the whole loan. They'll combine banks. Say it's $100 million or $60 million, they'll do 20 apiece. And one bank will service the loan. A lot of banks today don't feel secure lending large sums of money. As I said, I've had $60 to $80 million loans unsecured 8-9 years ago. And it worked out well. But with the government being, or the banking system being what it is, they're going to want participation. Do you ever get participation from different companies?
I started out as a lender, and we would do credit tenant loans. Large credit tenant loans, let's say you got a 20-year lease to the government, $100 million loan, or A-rated corporation. Even in that, with an A-rated corporation, the banks will often or banks or life companies or whatever will take like $20 million each.
Yeah, that's farm it out.
You deposit the loan into trust. They issue pass-through certificates. Each bank holds a note for $20 million or a certificate for $20 million, and the trustee administers the loan.
Yeah, one person. Yeah, and you have to have the foresight to know that. And you start out with the smaller loans, but I find if we as the professionals can get our clients to run their companies properly, and we go back with that pamphlet or that booklet to start the loan. The clients that I have that made the most amounts of money and walked away with enough money to never work again ran their companies like publicly held companies. They had quarterly meetings or monthly meetings with an outside board, and everyone from the CFO to the head of sales had to do reports. So when I had to do that booklet, it was easy to do because these individuals were doing it for me. And I just took what they did and put it in a booklet, cleaned it up, and made a presentation. But banks want to know all about the company. And if you're doing a $60 million loan, you have to understand right from day one you're going to need participation. And whoever that middleman is, like you said, has to say to the insurance company, do you want a piece of this? Do you want a third? It's a $60 million project, $120 million equity in the property, and you're only going to take a piece of it. And make the presentation like that. But you as a trustee, I've had one bank clean up the loan. Service the loan. I've seen it both ways.
Yeah. With life companies, they'll use a trust, pass-through certificates, and a trustee. With banks, one bank will be the lead bank and syndicate the loan. I haven't been on that side of it, but I've know enough about it.
But I've been around attorneys. Attorneys do a lot of loans. They never done a bank loan. An insurance company loan. They don't even know how to approach them. And I say insurance companies are lending money out. If they're paying out a point, they'll gladly take 6 points over a term. It's clean money, and all they have to do is service it once it's closed. Before I go into call and put options, when you have a problem, you've heard me repeatedly say today, work with the bank. Do not be a fool. Do not fall over. Do not tolerate their threats, but be flexible and make a decent presentation. The way you get a loan is the way you walk out of the bank with a loan. There has to be a lot of thought. You have to show there's no risk or there's minimal risk, and the bank is better off working with you to leave that bank than calling the loan today. I rarely, if ever, had a bank call a loan and close a business down. That's the last thing they want. They may not say that to you, They may want your client there so I can threaten you. They're talking to me but threatening you. But do a workout. I've been congenial at meetings. I've been flexible at meetings. I've been extremely hard at meetings. I've looked the banker in the eye and say, I'm using four-letter words back and forth, and try it. Because there reaches a point you have to show them that they reached the end of the line and they're unbearable. Their work is like a baseball reliever to get the final 3 outs. Their job is to get the money from you. Whether it comes from your mother, your father, your grandmother, grandfather, they want the money. And they want you to take the collateral and liquidate it. And I want, as I said, with the cure period, as you brought up, I want the flexibility to make them, let's deal with the business, you lent money to the business, and let's work out. Companies do close. It's usually due to mismanagement. Very few good companies that have proper management fail. You always have to expect the future, and that's what those pro formas are. That's what the financial covenants are. And if you have to merge and close, or you don't have someone to take over, you have to talk about it. Part of negotiations also is they have to allow, in the lending documents, estate planning. We had one recently where it came up, and the lending officer said to me, the client died. The loan's called. I said, I took that out of the document. No, you didn't. Yes, I did. No, you didn't. I took it out. Did the death of the primary shareholder, was that an event of default? Or I had one recently with 2 shareholders, or 2 members. One does financial, one does the bacon. Would either of their deaths be an event of default? And I took it out. I said, if they both die, okay. But if one of them dies, no. But I also want in there that I can do estate planning. As long as I'm there, can I transfer all the stock in trusts or to my son? As long as I'm working full-time. Negotiable. They'll usually have standard pre-printed documents if there's any transfer of ownership or any transfer of substantially all the assets. I'll usually try to, I'm jumping ahead, any mergers or liquidations or consolidations is not an event of default. I need some flexibility to do business planning. They'll say to you, the young attorney from the major law firm will say to you, well, we have to prove it. Why? I mean, we run our business. As long as you have the same collateral, the same owners, the same shareholders, the same directors, what do you care? We should have the discretion to do a consolidation or set up an affiliate or do some estate planning. You cannot get in the way of our business planning. We'll pay you the interest. You'll have the collateral. You have the same guarantees. Now, what happens if I had one guy come to me 15 years ago. He works for a subprime lender. He wanted a partner, a bank, to finance him. Many banks don't want to be in subprime companies. They don't want finance companies. They don't want grade C lenders. They love the profit, though. So they said to my client made the proposition, we did the booklet, we did the profiles, we did the history, we did the pro formas, we showed the contacts in 50 states that we could set up and have it set up within 6 months. We need licensing. He had the wholesalers, but we needed someone to fund it. Banks are scared, but they love that business. They love it. So you have to entice them to come in. But they don't want the public to know that they own that company. They own the finance company. Or they own the day, what's it called, the day trade lending, when you just go in and get a couple $100 or a couple $1,000.
Paycheck.
Paycheck lending. Or they're in the subprime business. You have to give them something more. And that's where put and call options come in, or a convertible loan. It comes under different names. They're all the same. Don't get hung up on the words. Could be a debenture, could be a warrant, could be stock options, or they could own it outright. But it's all the same. They want you to set up that company for them under a totally different name in a totally different state. And they have 50%. I will negotiate. I was in one meeting, it was up in Maine, and they wanted an S corporation. And I have an accounting background. I have no accounting backwards and forwards. And they said to me, we have to own 51%. I said, why? He said, tax reasons, sub S. I said, really? I said, maybe you're right. Show me the law. We're meeting next Monday. Show me the law. And if you're right, I'll give it to you. Otherwise, no. I knew what the law was. We go up the next Monday, and I said, show me the law. He goes, we went there. I said, show me the law. I said, don't ever do that to me again. I mean, we had a bitter conversation, but ended up it was 50-50. Equal say on the board. My client set it up. They did the funding. Owned up 50%. But what my client wants, he's an entrepreneur. He wants to be able to get out and force the bank to buy him. Or it could be done another way. I mean, you have to use your creativity. The bank may want to lend my client the money, but at a certain point, cash out without the public ever knowing. I'm talking about the retail public. So what they do is they'll lend him $50 million, but they want a 20% sweetener on that. So my client has nothing to begin with. So he starts out with the company, and he gives Bank X a 20% convertible loan. He's paying interest only for 5 years. So the bank has $20 million. After 5 years, the business is worth $200 million. The bank got all the interest over the first 5 years. So they want a put option. So they take their 20%, they convert it, and put it the same day. And get 20% of the fair market value. So they not only got their 8% interest or their 7% interest, they also got a buyout. Or my client does that. What one of these loans, and I'm all over the place, but you use your creativity. We had, by June 30th, my client had to do a call or a put on even years and the bank on the odd years. But there was a 6-month notice requirement, so each party could work on it. So my client was able to buy the whole company 4 years, 6 months into it. And the bank was able to buy the whole company on the other years. But it's all negotiable. But don't get hung up whether it's an option, whether it's a debenture, whether it's a warrant, or whether they take equity from day one. But most of these companies, they're risky loans. And some of these, I had one client that had been in 3 of these in the last 15 years. And they usually make him put some money in, not a lot of money, but some money. But how we do it is that profile. He's done it 3 times already. Each time the company was a bonanza. And everybody made money. And you could do it on a finance company. You could do it on anything that the bank wants a sweetener. Insurance companies love it. You know, on a real estate deal or a commercial deal, when they're lending money, they get that sweetener at the end. But it's usually if they convert it. And the value could be based on a fixed number, could be based on a formula, could be normally based on EBITDA. Or it could be based on a fair market evaluation.
Or it could be I have the right to buy it from you or to offer to you. If you don't buy it at that price, then you have to buy it from me.
That's the shotgun. I use that in shareholders agreement if there's a shotgun. You can buy me out But if you don't, I have to buy you out. I usually put that in shareholders' agreements. On putting calls, the bank, being the big guy, will usually want the first option, you know, to put or call. Normally, with these finance companies, they usually, or banks, they usually want to buy them out. They'll use my client. They don't have the manpower to set it up. So it's easy for them to fund it and give my client a 30% option or a 30% equity interest. I just did one. The bank held 70%. My client held 30%. He put $100,000 in it. They wanted something out of him. And he had 2 seats of 5 on the board. And after it was 4 or 5 years, they had a right to call, to buy his stock out. And once they bought it out, they paid him in cash. And he had to sit out 2 years. We had one recently. It was a company who went bankrupt, one of the big companies, insurance companies. And they wanted to give him stock. Stock was like $98 a share. He said, I want cash, I want cash, I want cash. So then he started to set up the next one. They hit him with a lawsuit immediately to uphold the restricted covenant. So he stayed out the whole year. The company went bankrupt. The insurance company, I'm sure you know who I'm talking about, he sent all the senior officers a $1,000 bottle of wine and said, thank you. Because he would have started up when the subprime just went belly up. So he was ecstatic. And this guy has done it three times. But you have to understand the process, understand the booklets, understand what you told me, and I totally agree with you. You have to send probably 50 of them out. But someone will bite. Someone will have an interest. And it could be anything that works with banks, that the banks are in. But they may not know how to start up, or they may not have the manpower to start up, or they may not want to put the investment in the startup. So it's easier for them just to lend money to the new company. And if the entrepreneur has a track record, they'll usually jump at it. They usually like it. But your client, when you do these lending documents, will want a way out. And if he's performing, he gets a nice buyout. I mean, I've seen some huge numbers on buyouts. And you look at it and you say, I mean, do this every 5 years and you get a nice salary while they're working there, and they have a say. But normally, like you said, if it's an insurance company or a savings and loan, they usually stay out of the way, and they let you run. They want to see the numbers. They want to see the weekly or monthly financials. But it's a couple of these, there's not a lot of them around the country. They have contacts in every state. The hardest thing is setting up offices in every state, but finding the mortgage brokers and having the contacts with them. But they want someone that they email a loan in, it's approved in 24 hours, and it's closed in 30 days. And most of them are residential loans or a second mortgage or a car loan, but they have to have contacts. And you have to have the servicing company, which you also brought up. Most of my clients who are in these businesses have servicing companies set up already. And they have the default rates, contra what the public thinks, they're not that bad because they're grade B loans, they jump on the people quicker. And the turnaround is much quicker. And the collateral's there. As long as you don't have fraud. I mean, as today, as anyone who borrowed money in the last 5 years, you have to have some ID at closing to be certain that you are Mrs. So-and-so or Mr. So-and-so. And you cannot be lending at 110% on fair market value. But I have a couple clients that went back into the mortgage companies and they're making money. And every one of them is in bed. They have a partnership with a major bank or a major insurance company. But you have to have call and put options. But also, even on these commercial loans, if you have a client, some of these banks and insurance companies are demanding some kind of equity interest. Something that either is equity from day one or can be converted into equity. But be aware of it. Know you're going to have to give it up. and be prepared to give it up. But if your client has very little equity in the company from day one, he's not giving up anything. I tell these young entrepreneurs, and there aren't many out there, and we have discussed it in my office many times over. There are many, I don't know about you, but there are not many medium-sized companies out there today. They're being bought up, and the young entrepreneurs are not going into business the way they used to go in business. The only two medium-sized companies I've seen recently are great graduates from phenomenal schools who are anti-terrorism companies. But going into like electrical supply or packaging or construction, I see very few taking risks. And they say banks are not lending. Banks are lending if you give the banks something. And you have to totally understand the process. Do you have anything to offer? You've been through a lot.
Well, I would say if you went to Texas, you would see entrepreneurs growing on trees.
In what? In
Real estate, construction, development, energy, pipelines. There's tons of business.
Older
There's
people or younger people?
Younger people. I'm doing business with guys who are constructing office buildings, 200 to 400,000 foot office buildings.
What are the ages?
They're in their 30s.
And banks are lending, or who's lending?
Banks are, yes, banks are lending. I mean, they're part of a larger organization, but they are entrepreneurs within the organization, and it's all across Texas. It's the right to work states versus the blue states. There's no income tax there. There's much less business regulation. Things are booming. Also, the energy business is booming too. So that affects a place like Houston. But Dallas is bringing in people from California. It's phenomenal. It's definitely a regional analysis within the country.
Well, I was told, I read this recently, that in Pennsylvania, where I'm from, we have Cleveland rents, but New York rates to build the buildings. And it says everything.
That's true. I would say the building I was looking at is a nice office building, 10, 12 years old. I think replacement cost is $260 a square foot with surface parking. I'm involved in a deal in Houston, building something at $200 a square foot, Class A, with structured parking.
Then let me ask you a question. Why would Wharton in Philadelphia and Columbia here, Harvard a couple miles up north, why aren't young guys opening up, or young persons opening up businesses here and getting the financing? You're saying it's not profitable enough.
It's a lot tougher here. You got union wages. You've got state income taxes. You've got tons of regulation, and things are more expensive. Look, there are plenty of successful people coming out of these schools doing businesses in the East Coast, but I can tell you the entrepreneurial spirit I see in Texas is incredible.
We don't see it in Philadelphia. We see the kids come out of Wharton and they go right up here and they work as an investment banker. They stay here 3 years, the cost of living kills them, and then they come back to Philadelphia working. Why are they not going into business? I have no clue. You know, I preach to my son. I mean, he's on his 4th property in a year, but you know, at least he listens. He says most of the other people are not listening. They got a brand new car. They're living in a $3,000 a month apartment.
Well, that's a cultural thing, right? The immigrants come here.
Exactly.
They scrape together their money. They buy a fruit store or a Korean deli like they have in New York. Pretty soon they have 7 or 8 of them. But they're living in a small apartment. They're driving some old car. Everyone here, you get out of school, you buy, your first thing you want to do is have a brand new car, nice apartment. You're pretty much a slave to the cost of your toys and your expenses, and you can't accumulate the capital to form a business, and you can't afford not to work for the salary you're getting.
Exactly.
And there's no sacrifice.
And I tell people, and I tell you about clients who started these lending companies, what did they have to lose? Nothing. Their bank is not going to take their home. And I tell them that. What risk do you have? We had one young man in the other day, or last week, and he took one client that's paying a nice salary, and he has 50% of his time off. And I said, go into this other venture. What do you have to lose? You have nothing to lose. I mean, my son, when his graduates out of Wharton said, you're not going to New York and make $150,000 to start. He said, I can always go there next year or the following year. What am I risking? I didn't lose my education. I mean, go back to law school when he got his MBA. But what was there to lose? I always say that to people. What is your risk? You were poor. You're poor now. You don't have any money now. You're working for a salary, just paying your bills. Take the shot.
Especially without a family.
Especially without a family, or without children, and without a home loan. But like you said, they want to live in the high rise. They want that brand new car, and they want to go away three weeks a year and go skiing every weekend during the winter. But give it up. And as I tell people, people think about law school being so difficult, or medical school. I say, you have to really work hard. 8 weeks a year to change your life. That's all it is, 8 weeks. 4 weeks for 2 finals for 3 years, and it's over. And before you know it, it's all done. I have someone working at my house right now who's starting medical school in the Caribbean in 6 to 8 weeks. And I said, why don't you try an osteopathic? She said, because down there, you go for 18 months. Next year, this time, I'll only have 6 months left. I come back here, they put me in a residency, and I'm an MD. 2.5 years later. She goes, next year, this time, I'll be all but done studying, except for 6 months. I'm done. It's the way to look at it. I said, look at it that way. It's not a bad way of thinking about it.
Smart.
But what I'm saying is, you have to do your homework. You just cannot, and I'm saying to anyone who's watching this, your client just cannot walk in and say, I want to start a business. Sounds great. I'm going to be rich. The bank's going to laugh at you. It's like anything else in life. You have to be prepared and assume risk. But you minimize your risk. Like I said to the bank when they upped the ante on my own loan, I said, you're asking me for too much. You're tying my hands. I can't do anything. And I will never allow someone to do that to me. I said, so I'll liquidate securities, buy it off, I'll pay the capital gains tax. I'll never be in that position. When I was 24, the reason I started my own law firm, I worked at a firm, someone brought Muhammad Ali in the office. And I walked in the associate's office who brought him in. He opened his drawer one day, had a gallon of vodka, and he said to me, don't ever be in this position. Today is my last day here. And I don't forget it. I mean, certain things in life you hear, you never forget. But that changed my life because I never wanted to be him. He told me, do not be me. He said, I'm out of work today. And he brought a superstar client in the office. So you learn things as you go along. Same what I said earlier today. Anyone could draft the best document in the world. Someone told me that when I was 24. Someone has to buy it. And don't be intimidated. I had Richard Sprague in Advanced Trial Strategy back in law school. And he always said, control the room. Be the straw who turns the drink. So when you're prepared and you walk in and know what you're bargaining for, you're in control. You know what you can do and know what you can't do. There's going to be times you're frustrated and you cannot work a deal. But I had a closing fall apart 4 months ago. The first closing I've ever had fall apart. I have no clue why. There's something had to happen behind the scenes. You usually know. Normally, when something goes that far and you're at the closing table, you close. You may take a couple hours, but you will close. So what I'm saying is when you're prepared and you have everything knowing and you're confident, because I was talking to David from Lawline, we're talking about public speaking. I said, someone in law school told me a trash man can talk in public, as long as he's talking about trash. So if you have that booklet and you know everything about that loan and how that loan is going to be repaid and how the bank's secure, you're controlling the room. And don't ever be intimidated by anybody. And that's what I tell a lot of young lawyers. Know everything about the loan before you walk in. My son, I said, show the 12 properties, show the appraisals, show the income, show our tax returns. and let them beg us for the loan. Okay, we're finished. If anyone has any questions, they can call me. I'll be on my cell for another half hour, 267-577-3807. Inside the booklets, we have a monthly newsletter that goes out by eBlast. If anybody wants it, joe@pizzula.com. That's P-O-Z-Z-U-O-L-O. It's Joe, J-O-E, @pizzula.com. We have a monthly newsletter that usually has articles in it like this. I believe next month it's going to be on lending. Some months it's on trust. Some months it's on employment. Some months it's on family law. But if anyone has any questions, I'll be available for the next half hour. Thank you.
Thank you.